has started. Let's have a look. 4.5. Okay, so we're going to do the financial interpretation on this business. Usually when we have this is one of the jobs an accountant would do. They hire accountants to come into the business, look at their financial statements, and then answer questions on it. And you get paid quite a bit for doing that, right? For your knowledge, for your opinion as an accountant, professional accountant, okay, if you want to move into that direction. So let's look at what types of comments we need to be making. Back to business. Morning, Ziad. Siyabonga, Ziad. If you have any questions about anything else, please don't hesitate to ask. We are looking at financial interpretation quickly, and then hopefully we can jump to a balance sheet note question as well. But we'll see how far we get. But if you have anything to ask me on accounting at all, please ask me now, since it's the last time I will see you. And let's go on. Okay, so the company is registered with a share capital of 500,000 ordinary shares. So we're going to go through this. We're going to talk about the comments, but I'll also try and give you some techniques just in case you go blank or you haven't studied maybe that particular section that hard or something like that. I'll try and give you techniques to get easy marks or get some marks at least. Okay, but obviously the best thing to do would be to go over all the work, study it. It is a little bit of study work, and understand what's going on behind all of these formulas. Remember, in the exam you will get a formula sheet, so you don't have to study the formula itself, but more the understanding behind it, right? First things first, calculate the number of ordinary shares issued on the 1st of March. First question that I got for you guys. Has ordinary shares been issued from last year to this year? Start you for the easy question. Looking at these post-go trial balance, has any shares been issued in the 2013 year, between 2013 and 2014? Yes, Sebon goes on it straight away. Lovely stuff. That's 300,000 one year and 420,000 the other year. So I'm guessing there was a share issue. So how are you going to check how much shares were issued for the year? You would take your 420, you minus your 300,000, and then divide it by the share price to get you the actual share amount. What is the share price? Is that something we need to work out? Oh no, never mind. The shares are issued at 150. So there you go. 420 minus the 300,000 divided by 150 should give you the amount. Let's check. Yes, so 80,000 shares were issued for the year. That is our first question. Any questions on that, guys? Go for it. There's a lot to do today, guys. I may not stop too many times to ask you guys questions. I do apologize. I should ask a lot of questions. You should be answering. More interactive is needed. But I just want to make sure I get through everything. Please stop me if something's not making sense. Especially because we are recording it as well. So you can go back to it. But this is definitely a time for more questions than me just talking. So please take advantage of the fact that you can ask me questions now. Comment on liquidity of the company. Refer to the ratios below. So we're going to be talking about, can this company pay off their current liabilities with their current assets? Can they pay off their most recent liabilities with the assets that can change the most easily to cash? Okay, your current assets, your cash, your inventory, and your trade payables. Those are the things, your trade debtors. Those are the things that can change easily, or the most easily converted to cash. Your buildings, your cars, and things like that, it's going to take forever to change to cash, right? Those are your non-current liabilities. We're not really worried about that. As we look, get your easy marks. Even if you don't know what the current ratio or asset test ratio is, the first thing you do, what's the first thing you do? You ask you, what do you talk about? First point, first mark on the board. What do you guys do? Any answers for that? For any ratio and for anything, what do you do? What's your first comment? What's your easy mark?
So don't you comment on the difference between the years?
There we go. Lovely stuff. Siyabonga. The first thing you're going to talk about is comparing last year to this year. That you will get at least 2 marks. 1 mark for saying it has increased or decreased from last year, and then even you can even say what the difference is from this year to last year. That's 3 marks in the bag. Then once you have those marks, you can say whether the increase or the decrease was favorable for the business or unfavorable for the business. 5 marks, easy peasy. Okay, let's have a look. Current ratio, it's gone from 0.8 to 111, and this one has gone from 0.38 to 0.47. Okay. Any comments from you guys before we have a look at the answers? What?
So would it be possible to say that even though they had an increase, it's not a good increase because their current ratio includes the inventory and the asset test does not include the inventory, so they don't have as much, what do I call it, like fixed assets to cover their liabilities if they take out their
Inventory.
inventories. Yeah.
Yeah. Perfect. Absolutely perfect. Except don't say fixed assets, say current assets. Fixed assets are those, your cars and buildings. So saying fixed assets, I think, would mark you down because now you're talking about buildings and cars. You say your inventory is coming out of your current assets. But yeah, perfect. Absolutely perfect. As you can see, they're trying to show you here that even though we can cover our liabilities in 2014 as our assets are bigger than our liabilities, it's still not a very good favorable, or it's still not favorable for the business, as when we take out our inventory or the least liquid asset out of our current assets, then it shows that our assets are still lower or we cannot cover our current liabilities. If we were put under pressure, it would be difficult for this company to pay off their current liabilities. Exactly like Siyabonga said. Perfect. Let's have a look at what the formal answer is for this. But remember, that is the difference. I wanted to say it, as Siyabonga has pointed out, the difference between the current and the asset test ratio is the inventory. You take out the inventory to show even more if you can actually convert your cash quickly to pay your current liabilities. It's a harsher test. That's why it's an asset test. It's a harsher test than the actual current ratio test. That's why it's an asset test ratio. Current ratio, it has improved. Get your easy mark. So it doesn't matter what you talk about. The first thing you say is compare last year to this year. And there we go. Then the liquidity of the company has improved, but there we go. It is still not acceptable. It's still too low. They need to get the current ratio. That's another one. Keep this also in your back pocket. If things are not going well for the company, you can also get a mark if you recommend what the ratio should be at, or what ratio is favorable to the company. Write that down, please, as an extra mark. Sometimes these financial questions go up to 7, 10, 12 marks. Then you would also recommend what potential should the company, or what they should strive for. Give them a goal as well as another mark, okay? Here it is. Try and get your asset test ratio to 1:1. Another mark for that as well. But that would be the extra mark, okay? If you get a question that's 7 to 12 marks, add this in. Add a goal for the company, okay? Is everybody with me? Just extra techniques and extra ways to score marks. Thanks, Siyabonga. Let's go on to the next one. What's going on here? Sorry, things are jumping around. Calculate the period for which the company has inventory on hand. Calculate the period in which inventory is sitting on hand. So how long does the inventory sit on the shelf before it moves over or gets sold, right? So the first thing I want to ask you is, whatever amount that we get, what are we timesing it by? If we do a ratio, we take the top number divided by the bottom number and we leave it at that because that is a ratio. When we need a percentage, we take that ratio and we times it by 100. What do we need? Oh, Siyabonga's already answered. I had a whole speech planned. Anyway, yeah, 365. You guys are still on it. We can move on. Let's go. 365. Now remember, when they talk about the average inventory, you got to have last year plus this year together and divided by 2. That's how you get your average. Keep that in mind when we talk about anything in days. We talk most of the times we're talking about an average amount. Yeah, perfect. Yeah. So if it's a percentage, we have to times it by 100. I was going to say in my whole speech, and because we are using days, it has to be 365, and then we'll get a day number. But yes, perfect. 365. Okay, let's have a look. Calculate the P. Oh, sorry, we need to look at the answer. But let's do number 3 and number 4 together because they are both about days. Calculate the average number of days the company has to wait before debtors can settle their debts. What amounts do you think we need to use for that? So we want to check how long it takes for people to pay off their accounts after they buy something on credit. How long does it take before they pay off their account? What do you think we should use for that? What amounts? Debtors control and credit sales. There we go. Nice. Let's see if we can find that. Those amounts. They must tell us the credit sales then, right? Oh, and they do. 426320. They tell us the credit sales. So now we need our debtors control because sales represents people buying things on credit, and our debtors control is how much people owe us, right? So the difference should be how fast people are paying us. The difference between the sales and the debtors control. There we go. It is times 365. So the average inventory over cost of sales is number 3. Sorry. I will slow down. Sorry about that. Okay. Number 4. Take note when we're using days over here, it's 365, and we use our average debtors. In the number 3, we used our average inventory. But for number 4, we try to figure out how quickly are people paying off their accounts after they buy something on credit. So we're taking our credit sales, which they've told us, and our debtors control amount, but the average. So we're taking last year and this year and dividing by 2. Once we have it, it shows it takes 50 days before people pay their accounts off. They didn't ask us to comment on this, but in my personal opinion, if they did ask you to comment on this, 50 days is too long. Okay, the average time that it should take debtors to pay their accounts off is 30 days. That is an industry standard. And as Matrix, you should know some of these industry standards. You want people to be paying off their accounts within 30 days. And you should have a policy also to say if you do pay it within 30 days, you get a free gift card, a 10 Rand free gift card or something. I don't know. But you should incentivize people to pay their accounts off within 30 days. So if you had to actually comment on this, it would be bad. Okay, this is too long. It's taking too long, and policies need to be made to encourage debtors to pay their accounts off faster. Okay, clearly this is only a 2-mark question, but it could have easily been a 5 to 6 marks. Let us go on. Okay. Calculate the earnings per share. So now we're talking about earnings. So after you have the amount that you need to be thinking about when using or when you want to do your earnings per share is, first of all, you need your share amount, how much shares you have, because it's per share, right? Yeah, check the LMS system there. the earnings, right? There's no, if you look over here, there's no earnings line. Where's earnings? I don't see earnings, right? Earnings. Siyabonga, do you mind just helping out Siad if you know it is? I'm not too sure where that is. But if Siyabonga can't help you, you need to ask Miss Barnard. She's the one that uploads the stuff to the LMS system, okay? I don't think I've ever used the LMS system. Okay, so earnings. Don't forget, earnings is when the company has their money, and after all the expenses and everything's been taken, now we have our earnings. What do we do with it, right? That's what we're trying to find out. How much earnings is left that we can distribute to shareholders and so forth and so forth. I'm a very lucky person. Okay, let's have a look at that answer. Right, remember we worked out how much shares were issued, but we want to use now the number of shares issued, which is our closing balance for shares, ordinary shares, divided by 150. Now we have our per share amount, right? And we want to use our net profit after tax. They were trying to confuse you because they gave you net profit before tax. And then they gave you the income tax. So what you needed to do, obviously, would be therefore to take your profit before tax and take the tax out. Because you need your net profit after tax. That's what earnings is. Earnings is what you have after all your expenses being taken out. Every single expense has been taken out. Now you have these earnings left. This is the profit that you can do whatever you want with, right? So that's the profit we actually care about. That's why we use that amount, the net profit after tax, in the earnings per share calculation. And we have 48.75 cents per share, right? That's how much earnings you can get. Now, once again, they didn't ask you to comment, but remember that shareholders, they can either put their money in a bank or they can put their money in this company. Now, if they had to put their money in a bank, they would never get this amount back from the bank. 48% a return from the bank is never going to happen. Usually it's between 10 to 12%. So this is a very good investment. This is a very good investment for the shareholders because they could potentially get 48.75 cents per share, which is pretty good. But for some reason, they didn't ask you to comment on that again. Okay, we only have 10 more minutes. So I want to have a look at the balance sheet question. Let's have a look at number 6 quickly. Look at that. Calculate the return on average shareholders' equity. So we did the earnings per share. Now we're doing the return on average shareholders' equity. So keep that in mind. We have to look at the average net shareholders' equity. What is the equity? Equity is your retained income and ordinary share capital, these two. But they need the average. So you need to take the one, add it all together and divide it by 2. That's how you find your average. And you put your net profit on top. That's the formula. I'm not going to go through the formula. You will get it in the exam. Let's talk about what this is actually doing. Why do we do this percentage calculation? It's the same thing now I said about the bank. Oh, no. Suddenly this thing jumped. There we go. The net profit before tax, and then as you see, it's the average equity, all the equity together, and the percentage is 27%. Once again, it's a much higher return than you would get from any sort of investment that you put into the bank. That's the kind of comment that you would make for this one. And the last one, net asset value. Net asset value, another name for net asset value, is equity. Okay, so this is your equity for the year, net asset value is asset minus liabilities. That's your net asset value, which is equity, if you think of your accounting equation. So we have our shareholders' interest, which is our equity, divided by the number of shares for our net asset value per share. And there we go. It's 2 cents per share. The question was, should you sell your shares for 2 Rand or not? And the answer is no, they are worth 2 Rand 14. So you should not sell your shares for 2 Rand. Okay? That is the question for number 7. And the last one, how can the company improve liquidity, right? How can the company improve liquidity? It's also, you can have some generic answers there. Does anybody understand? Does anybody know how a company can improve their liquidity? Any ideas? And when we're talking about liquidity, what's the goal? We want more cash in hand. So any ideas how we can do that? Very good, Ziad. And you would get a half a mark for that one, though, but you need to be a little bit more specific. If you're going to increase your income, I want you guys to just remember one thing about debtors, right? When we sell inventory, we're not actually getting cash, right? The only time we get the cash back is when people pay their accounts off. Then we're getting cash in hand, right? So how can we get more cash? Probably the best way to do that is to incentivize your customers to pay their accounts off as soon as possible. Does that make sense, guys? Get that cash from your customers as soon as possible. Decreasing your debtors control and making people pay with cash would get your cash. I understand that maybe it's in terms of debtors control, it's not as good, but all they're caring about now is liquidity. And the best way to do that is getting people that have bought things on credit to pay that account as soon as possible. Is that making sense, guys? One other way is then also the inventory. We want to get your inventory to change to cash as soon as possible. So start giving discounts on your inventory. And you may be running at a loss, but that's not the question. The question is, how do you improve liquidity? And how do you improve liquidity? Is by getting more cash. Get rid of inventory as quickly as possible. Change your inventory to cash and get people to pay their accounts off. Okay, those are two of the main ways to increase liquidity. Give discounts on your inventory. Give discounts on, have incentives so people pay you back faster. They can sell off excess stock before it becomes obsolete, i.e. give discounts on old stock. And they should try and collect debtors within 30 days. There we go. Industry standard, 30 days. Okay. Any questions, guys? When I quickly go to the balance sheet question. It should be time. 5 minutes. Give me 5 minutes, guys. It's just another set of slides I'm just getting quickly, and we'll have a look at the question. Probably won't have too much time to go through it, but I just want to go through the question, have it on the record, and then have the answer on the record as well, so you can go through it. But what we were looking at is, this is very important, guys. This is almost very closely related to your exam question. Please go to activity 3.3. It's got everything, it's talking about the accrued principal, it's talking about the notes and your income statement, which is very important for this exam. There it is. Start you doing the income statement and the balance sheet, and then you're working through these adjustments. But once again, it's all about those adjustments where you're getting income or expenses in the wrong time period, and you have to deal with it, making either an asset or a liability. income received in advance, accrued income, the expenses, and so forth and so forth. Also, when you're doing a question like this, and you're starting with the income statement and you're doing all the adjustments, just keep in mind or write on the side if it does affect the balance sheet, right? Because you do come to the balance sheet maybe 20 to 30 minutes after you're done with the income statement. And if you do that, you might forget what the debit or the credit is, right? Maybe you're decreasing insurance and then it goes to prepaid expense in your balance sheet. Make sure you just write it next to the insurance or write it on a piece of paper that needs to be in the balance sheet note. That's just one of the techniques I would use. Let me quickly just show you what the answer looks like. Now we're in a bit of a rush here. But these questions also tend to be a lot of marks. I didn't write down the number. Okay, 1 second. Let me get to 3.3. Sorry about this. I didn't write down the number. Almost. Okay, so this is the start of the question. You can see the income statement. Once again, we're doing the same sort of adjustments. The adjustments aren't the worst thing in the world. Don't forget to write your provision for bad debts adjustment that it usually comes in. There was a profit on sale of a disposal. One second before I let you guys go. Besides that, let me just show you. So when you're doing calculations, make sure they are in brackets. And now these also affect the balance sheet over here, right? These numbers. And you see the debit and the credit, don't forget. And also, when they tell you in the question, they tell you that what is on hand, that is your inventory note. They usually tell you trading stock is on hand for so much, consumables is so much. Those two amounts, is the note to your inventory amount. So don't forget that as well. But let me just quickly go through this so it's on the recording and then I'll let you guys go. I'll be waiting for questions on this activity. Don't forget to ask. Just so you can see everything. There was an asset disposal as well with a profit. But yeah, it's a very long question. Please have a look. Okay, guys, that is it. There are no other questions. That is it for today. But I am on WhatsApp. Okay? Please answer me. Ask as much questions as you can. I am ready for you. But if there is nothing else, guys, have a good day. I'll upload this by the end of the day. Good luck with your exams. Cheers, guys.